Dryrun's auto forecast was built with efficiency, accuracy, and flexibility in mind. It is usual to spend tons of time pulling together data from different sources, accounts, categories, usually onto spreadsheets, which can get messy really fast. But with Dryrun, you can skip all that manual work, seeing that we pull all of your historical information from your accounting software, creating a baseline forecast in just seconds. Plus, it's not just for one-off forecasts. You can create multiple scenarios just to see how different decisions will play out. It is a huge time saver and way more accurate than spreadsheet, especially when you need reliable insights for planning. And because everything is visual and very easy to share, it is perfect for getting everybody involved, from your clients, team collaboration, or even management meetings. After mapping your balances from your accounting software through our direct integration, or by importing your reports through your spreadsheet template, you will be able to select which auto forecast type you want to use for each one of your accounts. The auto forecast types that we have are map to last year, which essentially looks at your historical data and grabs all of your pay totals, or actuals, as we like to call it, to create that baseline forecast. Meaning that your 2024 pay totals for an account would become your January 2025 forecast. This is particularly useful for businesses that have a lot of seasonality or trends that they want to capture. And this is also a very useful way to compare and contrast how you performed against last year's totals. The map to recent month option, it is the one that we recommend for things such as your direct costs, fixed costs, office expenses, the rent, utilities, those accounts that you want to make sure that you're grabbing the most recent amount than say going back a year. Dryrun automatically captures the totals for 2 months past, just to account for things such as reconciliation, timing of the closing of the books. But you certainly have the option of choosing which month you want to model that forecast after. The other option is map to yearly average, which essentially just grabs an average of the last 12 months and adds that as your forecast value for coming months. The last option is, of course, to create your forecast manually. If none of these options apply, or you're looking for something a little bit more custom, you certainly have the ability of turning off the auto forecast and creating your own custom forecast. Keep in mind that this is just meant to be a baseline, an MVP, if you will, your minimum viable product. You can then make adjustments and changes as necessary. You can change the type of auto forecast on a section level by accessing your section settings. The other way of changing your auto forecast is on an account level, simply by clicking on the total and editing the type of auto forecast that you want to select for that particular account. This is where you can turn it off as well. With all this flexibility and automation, Dryrun truly allows you to focus on the strategical aspects of cash flow forecasting and management. Not only that, but it saves you tons of time and it removes you from those pesky spreadsheets. Visit dryrun.com to learn more.